Understanding market cycles. Before we dive into the potential crash, let's first understand market cycles. Financial markets move through predictable phases: expansion, peak, contraction, and depressions. These cycles are driven by economic activity, consumer behavior, and external shocks like geopolitical events. Take the Great Depression of the 1930s or the 2008 financial crisis. Both were preceded by telltale signs: inflated asset prices, unsustainable debt levels, and overly optimistic markets. History doesn't repeat itself exactly, but it does rhyme. The economy doesn't move in a straight line. It's cyclical. Recognizing where we are in the cycle helps you make smarter investment decisions, indicators of an impending crash. So, what signals should we watch out for in 2025? First, rising inflation. When inflation rises too quickly, purchasing power of consumers declines, slowing spending and impacting businesses. Global inflation is on the rise, not only in the USA as of January 2025, but also in Europe and even in Japan. Second, interest rate hikes. Central banks raise interest rates to combat inflation, but higher rates make borrowing more expensive, reducing corporate profits and economic growth. Just have a look at Japan, where they are just at the beginning of a major interest rates reversal not seen since 2008. Third, high unemployment. Rising unemployment is a red flag for weaker economic activity and falling consumer spending. Fourth, declining consumer confidence. When people feel unsure about their financial future, they spend less, rippling through the economy. Fifth, yield curve inversion. When short-term bond yields exceed long-term yields, it often signals an upcoming recession. As of January 10, 2025, the U.S. yield curve was inverted. In 2008, the yield curve inverted well before the housing market collapsed. Investors who paid attention to that signal were better prepared for the downturn. Lastly, stock market volatility. Increased volatility reflects uncertainty, with sharp price swings often preceding downturns. Staying alert to these indicators ensures you can adjust your portfolio before the storm hits. Currently, many of these indicators are flashing red flags, signaling potential trouble ahead. Coupled with the widespread market consensus that nearly all asset classes are hopelessly overvalued, it's a sobering reality. In other words, finding genuine bargains today feels more like a fairy tale from a long-forgotten past. The 80-20 investing philosophy. Let's take a moment to discuss a timeless strategy that can transform your investment approach. The 80-20 investing philosophy, inspired by the Pareto principle. This principle suggests that 80% of your investment returns often come from just 20% of your portfolio. The key to success is identifying and focusing on that top-performing 20%. 1. Focus on your circle of competence. Warren Buffett often emphasizes investing in areas you deeply understand. Your top 20% should align with sectors or industries where you have expertise or insight, whether that's technology, healthcare, or renewable energy. 2. Reinvest your gain. Use the cash flow generated by your best-performing investments to compound returns over time. For example, reinvesting dividends from ETFs or stock gains into high-quality assets amplifies your portfolio's growth. And 3. Simplify your strategy. Instead of managing 50 different stocks or ETFs, narrow it down to your best-performing ones, or invest in diversified funds like the S&P 500 index. By focusing your energy and capital on the top 20% of assets, driving most of your returns, you simplify decision-making, reduce risk, position yourself for long-term success. Investment strategies for protection. Now that we've identified the warning signs and introduced the 80-20 philosophy, let's explore specific strategies to protect your investments. Number 1, diversify your portfolio. Spread your investments across asset classes like stocks, bonds, real estate, and alternative assets like gold or crypto ETFs. Diversification reduces risk by ensuring that if one sector falters, your portfolio remains more stable. Number 2, defensive stocks. Invest in sectors like utilities, healthcare, and consumer staples, which are known for their resilience during downturns. High dividend-paying tobacco companies are another interesting example. While they may not be the most appealing option in booming markets, during bear markets, they can serve as a psychological anchor. Historically, consumers tend to stick with habits like smoking, even during the toughest economic times, sometimes even reverting to traditional tobacco products. This consistency can provide steady returns when other sectors falter. Number 3, maintain liquidity. Cash reserves and an emergency fund covering 3 to 6 months' expenses act as a vital safety net and enable you to seize opportunities during a market downturn, or take it a a step further in your squirrel quest for winter is coming. Take Warren Buffett, for example. Through his company, Berkshire Hathaway, he's holding an impressive cash reserve, over $150 billion, according to recent reports. This massive cash stash reflects Buffett's disciplined and cautious approach to today's market condition. Now, that's what you call being prepared for a rainy day. Number 4, rebalance your portfolio. Regularly realign your investments with your goals and risk tolerance as markets fluctuate. And number 5, focus on high-growth ETF. Look into ETFs tied to sectors like renewable energy, artificial intelligence, and biotechnology for future growth potential, as long as it is in your personal circle of competence and you feel personally comfortable with such investments. Masayoshi Son of SoftBank is a prime example of a bold visionary willing to bet everything on transformative technologies. He has famously directed SoftBank to double down on artificial intelligence, seeing it as the cornerstone of the future. Son's belief in AI is so profound that he has positioned entire segments of his company and even taken significant risks on this technological revolution by pouring billions into AI-focused startups through the SoftBank Vision Fund. He's essentially betting the company's future on the exponential growth of AI. This is a high-stakes move, but one aligned with his track record of making visionary investments, such as backing Alibaba in its early days. Whether his bet pays off remains to be seen, but it's clear that Masayoshi Son views AI as the ultimate disruptor that will redefine industries, economies, and how we live and work for decades to come. Utilizing financial tools. To further protect your investments, consider these financial tools. First, stop-loss orders. Automatically sell a security when it hits a specific price to limit potential losses. Use them sparingly and only with the highest attention. We have seen clients losing fortune by being pushed out of valuable long-term positions. Second, options trading. Advanced investors can use put options as insurance to hedge against potential downturns. Again, pay special attention to these hedging positions. They are high maintenance but are useful tools to balance market price losses. Third, dollar cost averaging. Consistently investing a fixed amount, usually on a monthly basis, also known as dollar cost averaging, can help minimize risk and take advantage of lower prices during downturns. While here at 80-20 investing, we don't see this method as the most strategic. It can feel like a robotic, mindless approach to buying. It does have its place as a valuable tool in a broader investment strategy. Lastly, consult financial advisors. A knowledgeable advisor can tailor strategies to your goals and help you navigate turbulent markets. Let's move on to psychological preparedness. Market crashes aren't just a financial challenge, they're an emotional one. Fear and panic can lead to impulsive decisions, like selling at the worst possible time. Here's how to stay calm. Stick to your plan. A well-thought-out investment plan acts as your anchor. Avoid over-monitoring. Checking your portfolio too often can amplify stress. Learn from history. Markets always recover from crashes. Staying invested is often the best strategy. Remember, if you've built your investment platform on a solid foundation, you should always have free cash flow consistently coming in, whether on a monthly or even daily basis. This steady stream of income acts as a psychological safety net, giving you the confidence to make sound decisions without overreacting to market fluctuations. Knowing that new cash is flowing in every single day or month of the year can provide the stability and clarity needed to stay focused on your long-term financial goals. By mastering your emotions, you can make rational decisions that align with your long-term goals. So, what to do after a crash? If a crash happens, it's not the end. It's an opportunity. Remember the old adage, often attributed to Mayer Rothschild, buy when there's blood in the streets. While he may not have invented the phrase, he certainly reiterated its wisdom. Market downturns often create opportunities to acquire high-quality assets at discounted prices, setting the stage for significant future gains. 1. Look for undervalued assets. During sell-offs, high-quality stocks or ETFs often trade at a discount, offering a golden opportunity for value-driven investors. More importantly, focus on investments within your circle of competence, areas where you have deep knowledge and understanding, and that does not mean buying stocks or ETFs, but buying small businesses or real estate in your neighborhood that come on the market at depressed prices due to forced selling. This insight gives you the confidence and clarity to identify undervalued opportunities and make well-informed decisions when others might be acting out of fear or speculation. 2. Reassess your strategy. Review your plan and adjust as needed. Were there lessons learned? And 3. Stay patient. Recoveries take time. Trust the process and remain focused on your long-term objective. Remember, patience is key. With your cash engines running at capacity, generating steady income, you can rest easy, knowing you have the financial stability to weather the storm and seize opportunities as they arise. Stay disciplined, stay resilient, and let time work in your favor. For some inspiration, let's look at a couple of case studies. During the 2008 crash, Amazon's stock plummeted to just $40. Today, it trades at over $3,000. Investors who stayed disciplined during the downturn and held their positions reaped extraordinary extraordinary rewards over time. The most iconic example, however, comes from Warren Buffett himself. Known for his calm and calculated approach, Buffett consistently loaded up on his favorite stock and businesses during market downturn. Coca-Cola stands out as a prime example of his strategy. It not only recovered explosively in price, but became a cornerstone of his portfolio, exemplifying the power of focus and massive concentration on what you know best during turbulent times. Here's the warning to those with leverage. This is a critical warning to anyone who might be gambling with excessive leverage. While leveraging up to the hilt can yield enormous profits during boom phases, it becomes a ticking time bomb in a downturn. In market corrections or crashes, leverage becomes your worst enemy and inevitably leads to what value investors call forced selling. So, what is forced selling? Forced selling occurs when an investor, unable to meet margin calls or service debt, is compelled to sell assets at depressed prices. There is nothing more painful for any investor than being forced out of a position you're 100% confident will recover and eventually be worth multiples of its current value. Imagine watching your next Apple, Amazon, or Nvidia investment slip through your fingers, knowing full well that their potential will only be realized by someone else, someone who likely had the patience and liquidity to step in at the right time. Case studies from the 2008 crisis. Take the former directors of Lehman Brothers and Bear Stearns, for example. During the 2008 financial crisis, many of them experienced the ultimate humiliation of forced selling. They blamed the economy, regulators, and even fate for their perceived misfortunes. But in reality, their downfall was fueled by over-leverage and a lack of preparation. While they scrambled to salvage their positions, seasoned value investors with cash reserves were on the other side of the transaction, quietly picking up high-quality assets at fire sale prices. The humiliation of being on the wrong side. When you're forced to sell, you're not just losing money, you're also handing over your opportunities to a buyer who likely planned ahead. Value investors thrive in such scenarios. They wait patiently, conserve cash, and swoop in during crises to buy undervalued assets at a discount. For a leveraged investor, this moment can feel like the ultimate defeat, a harsh reminder that greed and a lack of caution often come with a heavy price. The importance of reducing leverage now. If you're heavily leveraged, now is the time to reassess. Greed can blind you to the warning signs of a downturn, but ignoring them can be disastrous. As of January 2025, there are plenty of red flags building up in the market. Rising interest rates, declining consumer confidence, and an inverted yield curve. Just to name a few, these signs are clear indicators that a correction is not just possible, but increasingly likely. Take a step back and reduce your leverage while you still can. Cut your risk exposure, increase your cash reserves, and position yourself to act as a buyer rather than a seller during a downturn. Remember, the market rewards those who have the patience and discipline to weather storms, not those who chase quick gains at the cost of long-term stability. Now, here's my final thoughts. Leverage is a double-edged sword. It can amplify gains, but it can also accelerate your downfall. If you're not prepared for the worst-case scenario, it's better to play it safe. In a market downturn, the difference between forced selling and opportunistic buying often comes down to one thing: liquidity. The question is, which side of the transaction will you be on? So let's recap. Understand market cycles and watch for key indicators like inflation, unemployment, and volatility. Apply the 80-20 investing philosophy by focusing on the top-performing 20% of your portfolio. Protect your investments with diversification, defensive assets, and building up cash reserve, like Warren Buffett has been doing for some time now. Leverage ETFs and crypto ETFs to align with future growth trends. Stay calm, stick to your plan, and remember, every downturn brings new opportunity. If you found this video helpful, don't forget to like, subscribe, and share it with fellow investors. Get your copy of the 80-20 Investor, Modern Investing, Gambling in Disguise. Amazon links in the description below. And if you'd like to receive regular market updates from the team at the 80-20 Investor, subscribe to our free newsletter in the link below. Let's prepare for the challenges ahead and make 2025 a year of smart financial decisions. Thank you for watching, and we'll see you in the next video. Disclaimer: the information provided in this video is for informational purposes only and does not constitute financial or investment advice. Always consult with a licensed financial professional before making any investment decisions.